Every day, traders and investors dive in to tackle the ever-changing markets to find opportunity. Futures Radio Show is your number one source for answers to the questions that all market participants want to ask. Veteran futures trader Anthony Crudele sits down with the most influential leaders and top traders in the industry. Now, here's your host, Anthony Crudele.
What's up, everybody? Anthony Crudele here, and thank you for tuning in for this episode with Ira Harris. Futures Radio Show is sponsored by E-Mini Group. They are the world's leading and most diverse futures and options exchange. E-Mini Group's markets help individuals and businesses around the world effectively manage risk. For access to free educational tools and resources for the active individual trader, please visit activetrader.cmegroup.com. New shows are posted on Mondays and Thursdays. You can subscribe to the show on iTunes, YouTube, Google Podcasts, Spotify, and Stitcher. If you're enjoying the show, please leave a review on iTunes. This show is also sponsored by Trading Technologies, FTSE Russell, and RJO Futures. RJO is a long-standing brokerage firm with personal broker relationships to help you learn and trade futures. Please visit rjofutures.com to learn more. Today, I spoke with futures trader and author of my favorite blog, Notes from Underground, Ira Harris. If you've listened to this show over the years, you know that Ira is my favorite person to speak with about what's happening in macroeconomics. He explains it in a way that myself as a day trader can actually look at my charts after hearing Ira speak and use his information to help me with my trading. This year, I've been talking a lot with Ira, and he's been focusing on the U.S. dollar. And right now, Ira believes that the U.S. dollar is at a critical juncture. He explains why Memorial Day was a turning point for the dollar and for U.S. equities. Of course, we talked about gold and treasuries like we always do. And last but not least, Ira explains why he's not fading the Fed just yet. So without further ado, let me take you right to my interview with Ira.
Hey, Anthony, this is one of my favorite stops on the Discussion Express. This is really, you do such great work. I'm proud to be been proud to be part of it for quite a long time. So thanks.
It's always an honor to have you on the show, my friend. Thank you so much for coming on the show so many times and speaking with me. And a lot of times when we get on the show, I always ask you, what are you seeing in the markets? What are you thinking about? And today I just want to get right into it. What are you currently trading right now? What markets do you have positions in?
It's been a focus of mine. Since Memorial Day weekend, I've actually gotten very bearish the dollar. I think last time we were on, we were talking about potentially, but there was an event that happened over that weekend in Germany with a guy who I hold a lot of respect, but he did a pivot. Wolfgang Schäuble, who's the president of the Bundestag. We'll talk more about that. So I've been in a bearish dollar mode. It's actually been a 4 or 5% move since then, and it actually carried the equity markets higher too, which made perfect sense to me. The debt markets aren't going anywhere because the central banks just are all over them. So I believe that the Fed wants a lower dollar. They can't say it. Their policies, watch what I do, not what I say, because that's not their purview. So I've been watching this, and now we're at a critical juncture. So we're actually having a very good time. And this is, you and I have never discussed this, meaning this moment in time. So that's where we're at right now. And today is actually reflecting it. And I'll explain to you why.
Yeah, you said we're at a critical juncture right now. Continue on that thought.
Yeah. So, I've been in a few places discussing this. So since Schäuble's, what I call his pivot, which was him, and he's Mr. Fiscal Austerity, but he made a comment after what is called the Frugal Four, which is Austria, the Netherlands, Denmark, and Sweden, who were opposed to grants to Spain, Italy, Greece. People who were some of the southern economies who were really hampered with the COVID crisis, and certain people in Europe wanted to create a euro bond, which we've talked about many times, but they've never gotten there. And it would be for money on a unified euro bond to give basically via grants, and then it would be paid back over X amount of time to the countries who are in need. Now, the Frugal Four, as they're called, said no grants, loans. And Schreibel came out that weekend, and Adam Tooze, I give him a lot of credit because he was one of the few people who caught it. And he wrote about it, but Schreibel made a comment. If you give them loans, it's like giving them stones, meaning you're just weighing them down. But giving them grants is like giving them bread. That's a significant thing for somebody who's so fiscally conservative. So you watch from that date, which is the May 24th, May 25th, Memorial Day in America. So U.S. markets were purportedly closed, but we know Globex is open. And I was actually trying to buy euros all morning. Didn't really go anywhere. But the next day, the euro actually appreciated about 1.5%. So it was an interesting play, and you got movement in the bond market, meaning in the European bond markets. You got compression. The Italian-German differential dropped from about 250 basis points on this move down to 160 basis points. So 90 points compression, that's a huge move. And the DAX became the leader of the equity markets. And in fact, even when the currency is strong, the DAX performs pretty well. So I think that was a sea change. And it got me to be bearish the dollar because I believe the Fed would like to have the dollar go lower. Again, they can't talk about it. It's not their purview. The Treasury talks, that's their purview. But everything that the Fed does is geared towards fundamentally weakening the dollar. And I think that they would like a weaker dollar. So I'm bearish. But at this juncture where we're at, this is very important, technical, and I know you respect technicals as I do. You're a pretty good technician, more than pretty good. So this over the last 3 weeks, the 200-week moving average in the euro is at 113.30, let's say. And it's been a great pivot because we've actually rallied from 108 through there over these last 4 weeks. But that has been a pivot that has not been able to close over on a weekly close. Yesterday, Monday and Tuesday, we got a pretty good rally, even with the U.S. equity market up pretty good. The German markets, the DAX was strong too, and the currency was performing very well. Then today, of course, we have the sizable break in the S&P, supposedly off some trade frictions between the U.S. and Europe, blah, 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 other things going on. But the euro isn't really under that much pressure. It's given back some. It's given back down about 1/3%, maybe 1/4%. But yesterday, to go with the strong euro, or actually Monday and Tuesday to go with the strong euro, we got a strong yen. Now, it's like I was in White Wave, and I asked them the question, if I told you that the S&Ps were down 3%, which they were at the time when we were having the discussion, how much higher do you think the yen would be? And they said, 50, 60, 70 ticks, speaking in IMM terms. But yet the yen was down with the euro. So that's some of the algorithmic correlations that have been predominant starting to break down. Because yesterday, the yen was up very strong with an up S&P market. So what would have been traditionally risk on would have led to yen selling. Not so. So these are some of the relationships I'm starting to pay close attention to. And the yen on a technical picture is mimicking the dollar index, because the dollar index is absolutely in lockstep with the euro. They both have pivoted around the 200-week moving average. The yen has been above its 200-week moving average for quite a while, but they're now going in sync. This has my attention.
All right, a lot to take in there. I have a lot of questions following that opening, your opening thoughts. First is, you've been very consistent this year with focusing on the dollar. And, in all the years that you and I have been talking, I mean, I know that we always talk currencies, but over the last several years, it's been a lot about yield curves, trading, bond and treasury markets, and that's really kind of on the wayside right now. But lately, this year, you've been really focused on the dollar, and I wanted to pull up on my chart when you were talking about the dollar and just look at it in that Memorial Day weekend. And this is why I love your blog and love speaking with you, because what I look at there was you had a dollar rally, came back down into a consolidation for a period of time. And then this headline, actually on that day, I'm looking at the 26th of May, is when all of a sudden we started to head lower, where I think probably a lot of people were probably expecting the dollar to go higher. But that one statement, obviously, hearing it from you now, that's what triggered the market to go lower. And you said that it made you very bearish the dollar, but you turned around and clicked in long in the euro. There's a lot of things that could be happening if you see a headline that would make you bearish dollar, but you decided to click in the euro. Was that the only trade that you did?
That was the only one. I wanted to end the European bond compression. So I bought some Italians and sold the bunds. I like to do the butterfly because there's some, there's a lot of risk in the European debt markets, but they trade very actively. But you're battling the ECB as we're battling the Fed. But I know we'll get to that. Yeah, it was the euro, because when a man of that, or a person, man, woman of that stature makes that type of pivot in that much of an assertive way. Now, I also thought it was even more powerful because being who he is, okay, he's the president of the Bundestag. But before that, he was the German finance minister under Merkel, and very, very highly thought of. But that he did that pivot, then it brought me back to something we discussed, with the German court, which threw a lot of things into disarray in Europe. But here you have the most critical person as the head of the Bundestag, which puts him, from my understanding of German politics, which is pretty deep, that he's the second most powerful person because he controls the legislative agenda. Well, when he takes this position, it's kind of tough for the German High Court to say that the ECB is taking away the fiscal responsibility of the German legislature. So that what really played to my thought, that, hey, wait a minute, this is a big change, and this is a powerful, powerful person. I have to pay attention to this. And I thought it was good for the whole world, because then it was going to be able to unleash this and take away one of the major levels of uncertainty that I think has, hampered global growth, by the way. So you overlay the S&Ps with them. I think you'll see that this really unleashed the next leg of the rally in global assets.
Yeah, I'm looking at the chart right now. I mean, once again, you had a consolidation. The S&P actually at the time, when I look at this, was holding below the 200-day moving average. The next day it got above it, it closed above it, and then, off we went. And
you see it.
Yeah, you see it. And we're actually, the past, week or so, we've been going back to that area. And to me, it seems like that's just obviously a critical point. From the dollar to the euro to the S&P, go back to that day of basically, if I'm looking at my chart, it's like May 26th is the date I would pull up. And
that's the Tuesday.
That's the Tuesday when they open. Yeah. And then,
right.
Okay, I want to stay on the euro here for just a moment. Actually, why you chose the euro. And the reason I do is because I want to really learn more about your process as to why you chose the euro for this trade. Because let's face it, you get a bearish dollar headline. There's so many different places to go, but you chose the euro, and you've explained a little bit as to why. But I'm really curious as to what the process in your mind that occurs for you to narrow it down and go, that's the reason why I chose the euro. This is where I'm going to be able to go in, and this is where I think the market's going to be the most sensitive and potentially the greatest opportunity for a trade.
Okay. It's a great question. Now, I came to the IMM with a deep knowledge of foreign currencies because that's what I studied in graduate school. quite a bit. But as a currency trader, and floor traders will understand this. So after I was there for 4 or 5 years, and then things started to slow down at the Board of Trade, and a lot of Board of Trade traders came over to trade currencies because currencies were really hopping, and a lot of them had seats or they rented seats, and I would watch them. And Board of Traders had a contrarian nature, especially those who came out of the grain pits, because the concept was the customer was basically always wrong. And that led, it was easy to get there because, for every buyer there's a seller and there's a winner and a loser, and the public was of course going to be the loser. So it's not true in the currency markets, because I would stand there and watch and be part of them, and everybody in the pit could be buying and getting long, because the liquidity provider, the other side, was somewhere off in the world somewhere, a bank in Malaysia, somebody else was doing. So everybody you're standing around could all be making money, and that gives you a different perspective, okay? So I'm not contrarian by nature. And I would say to Board of Trade guys, just because the paper, quote unquote, paper is buying, don't stand there and sell, because it's not coming back to you. The primary market is far removed from you, and you can't see it. And you're going to get caught. And sure enough, a lot of them became short-time currency traders because that phenomenon did not work. You understand what I'm saying?
I'll be honest, kind of. I'm not 100% sure, right? Because I guess look at it this way. I just want to say this. So instead of shorting the dollar or buying the S&P, because when I go back and look at both of them at that moment, it's like, how do you choose which ones you're gonna take? Because even you mentioned, I wouldn't be surprised if that was something that impacted equity. So it's like, why not buy the S&P? Why not just sell the dollar?
Yeah.
Why choose to buy the euro?
You can, but that's why I brought up the concept of a contrarian, because I'm not a contrarian by nature. In fact, I don't. When that kind of mentality was you're always rooting against the customer. Well, I root for everybody. I want everybody around me to make money, because you know what? The more money people make, the more liquidity there is. And at that time, I was doing currency arbitrage. So I understood that that the liquidity was coming from somewhere else, okay? And that there could be 20 people buying from me, for my offer, and the market keeps going up. I don't have that power. The retail is actually pushing it. So what I'm trying to make the point is, so why do I look at the currency? Well, I know from all the discussion and the discussion on my blog, people were bullish the dollar. People were very bearish the euro. Oh, it's not going to make it. And believe me, my views. For me to be bullish Europe, that's a sea change, because they've had so many problems. And I was not my feelings about Draghi, but I did a big switch early on Lagarde. And then when I saw this, and I said, wow, there's an awful lot of shorts there. And nothing said it better than, we like to talk about the crosses. So people, all you do is have to look at euro yen. People were short the euro against the yen. They were talking, in fact, somebody from the CME did a report that same week talking about the euro Swiss going to par. The euro Swiss was, I think, trading 105. And I'm going, no, you're not understanding what's here. And the euro Swiss went up to 109. So everybody was short the euro on all these spreads and everything. So I thought that I would get more oomph on the initial move from all the shorts that existed. I think that answers the question. That's where I was going anyway. And that's not my nature to be a contrarian. I'm not a fan of the CFTC Commitment of Traders report for that reason. It's not something that excites me, because I understand that the positions that they show are not really reflective of what the positions are, because they can be arbitraged or hedged away in so many different areas that you don't know what the real positions are. I think it's a false read, by the way. So I thought that with all the shorts in the euro, and this being a significant change in thinking, that's where the greater opportunity would be.
Understood. Okay. I want to move on and talk about
but you're right. look at the S&Ps. There were a lot of ways that played out, by the way, as you well noted.
Yeah, I mean, that's why I was asking.
Yeah.
I'm wondering why. I'm trying to get inside your mind and say, you hear that comment, you understand what's happening, and you go to the euro. Like that was your choice because there was options there. There was options for you to choose where you could go, right? But that's the one you chose.
You could have bought the Italian bond futures, and you know what? And I did. So, but the euro was more significant because I am a currency trader first and foremost, and I look to them. But again, as we've talked about, if there's no trade, there's no trade. But if I told you that the euro yen, and let me take a quick look at it, as long as we're discussing before we jump on to the next one, because I'll show you how that would play out. Because that's been, people were worried about the euro, and myself included. So in early May, we had made a low for a substantial amount of time. That was a multi-year low at, in fact, it was almost a 3-year low. We made it at 114 on the cross. I'm speaking in cash terms now, not futures terms. So we made a 3-year low, and then it rallied within a week, by the way, a week and a half. It rallied almost 8%. Think about that on a cross rate. So that really reflected that my sense of, well, this is where all the shorts are and they're going to have to cover. And they did. And it led. And now we've kind of run right into that wall of the 200-week moving average. So by Friday's close, it will be interesting to see if we can get above one. I'm talking about in the spot. I'd like to see it close about 113.50. We're trading right now at 112.70. So not a gigantic move, but a nice move. So that's my thoughts.
Okay, traders, we're going to pause for 30 seconds and we'll be right back. The Russell 2000 is a key benchmark for small cap U.S. stocks. Be sure to check out the E-Mini Russell 2000 futures symbol RTY and the Micro E-Mini Russell 2000 futures symbol M2K. To learn more about FTSE Russell and their products, please visit FTSERussell.com. A question I constantly get is, what platform do I use to trade futures? Well, I use TT. They are the world's fastest commercially available futures trading platform. You could try it today for free at tryttnow.com. A lot more I want to talk about, so I want to move on and talk about gold a little bit because obviously, you and I have talked about, we talk about gold pretty much every time we talk. And I went back to that date, pulled it up on the chart, looked at what gold was doing, and gold broke with the dollar actually, and now it's come back up. It's attempting to break out maybe to a new high here soon. What are your thoughts now that you're so bearish the dollar? Is that impacting your decision making on gold? Is it separate?
That's why you're great at this, because we've talked about it, and it's always been gold currencies, right?
Yep.
We talked gold euro, gold Swiss, gold yen, gold yuan. We've talked about that over the years. And that's why if this becomes a dollar down play, I'm hoping that the gold kind of just sits there at these highs, doesn't really do anything, and the gold currencies unwind a little bit as people move back into some currencies and out of gold where they have hung their head. But I think, you know me, Anthony, I've been very consistent for 10 years. Longer, 20 years, but we weren't talking about it then. In that gold is a hedge against central bank losing credibility. That's what I believe. Now, does that ultimately become inflationary? Probably, but my statement is not that gold is a hedge against inflation. That's the popular narrative, but that's not what I accept. In a fiat currency world, gold is the ultimate currency, and as a store of value. And that's what it's done. As the banks have gone wild, as the banks are on spring vacation down in, where do they go? In Lauderdale, gold has been acting as the adult in the room. And it's been a preservation of value. That's all. And in a zero interest rate world in which we reside, it doesn't really cost you anything to own gold, and it does act as a balancer against central bank losing their credibility. Now, when I say that, people say, "Oh, the central banks have great credibility." Yeah, if I watch, the popular television shows, they all come out. Because if I'm a Wall Street person, I love the Fed. The Fed's done a great job. I'm a hard money person and believe that debt is a serious issue, and the financing of debt is a serious issue, and my life doesn't revolve around the last tick in the S&P value. The central banks haven't done a very good job, and I'm very fearful that we're now existing in the world because they don't have an exit. And that's the real scary thing. Central banks do not have an exit. And I can say that with certainty because I can go back to May 2013 with the famous taper tantrum. And I wrote a blog in real time on that day that Bernanke made a huge mistake when he walked back out of fear of the taper tantrum, because he should have let the markets work and the Fed would have been able to at least have some type of exit strategy out of the massive QE program. But as soon as he cowered in the face of the fall off in bonds and stocks, the street knew that they owned them. Yellen tried to escape from it, but she caved also. And we saw Powell, and you and I talked in real time. That was going to happen. In fact, I went back and viewed a Santelli I did in July of 2018, absolutely talking about, because we were looking at the yield curves, which had inverted. And Rick and I, July 10th, I was just looking at it because now I have some time because I'm on a little hiatus here to go through some stuff. And that was really important. And then comes the fourth quarter of 2018 where bonds get whacked and stocks drop 22-23%. Why? Because the Fed is tightened and they've also shrunk the balance sheet, which then Stanley Druckenmiller in December comes out in an interview and says that double shotgun approach was a gigantic mistake. And then we get the Powell pivot in January 2019. And as you and I talked about many, many times, the story of the equity markets and other things in 2019 was taking back the entire fourth quarter break, right?
Yep.
So then we finally, but that was all due to the Fed caving and not staying the course one way or another. But I believe with Santelli, when and Rick and I hit, it's there for everybody to see it, July 10th, 2018, that it was a mistake to do both, as Druckenmiller said in December, do one or the other. If you're going to raise rates, don't shrink the balance sheet. And my preference would have been, as a longtime Fed observer and global macro trader, that he should have begun shrinking the balance sheet. That would have been a much better route. And then they just caved. So we get the Powell pivot in January 2019.
I credit you with teaching me really about gold and how you said it really is. It's about the central banks losing credibility, because for years you hear that gold is a hedge, right? In many senses, right? They always say it's a hedge against all these things, right? And I always I'm somebody who goes, okay, if that's the case, let me look at something to prove it. And I look at the chart and I go, I remember in 08 and 09, you got to be buying gold. Well, the gold didn't rally until the S&P rallied back, right? And you look at this year, it made the low when the S&P made the low, and then gold rallied with it. And I look at it and go, how could be buying gold on the way when equities are getting ripped lower be a hedge? They never bounce until the equities bounce. I mean, that's just what I see.
Yeah. Well, people are liquid. People are selling assets in that world.
Exactly.
As Dennis Gartman always talks about, that when the margin calls come, he says when the panel player, when the whorehouse gets raided, meaning massive margin calls, even the panel player gets arrested. And it's really a great.
It is a great line. But but that's what I'm saying. So it's not really a hedge. I mean.
No, it's not. It's not. It's a false, because then they've both been going up together, right?
Yeah, I mean, that's what I'm saying. I mean, that's why I look at it.
Yeah.
I'm looking at it. I'm not saying that I know the entire details between how, if you're owning an equity portfolio and how much gold is helped by owning some of it and down moves. I just look at the chart and go, if I'm long the S&P, buying gold when the S&P is going down in hard times, when we have bear markets, That's not a hedge. I'm losing more.
You know what? But, and, you know, the argument, I know you've had some of the people on, you know, a lot of people out there who think deflation. Well, if that's the case, gold ought not to be going up. So you say, well, they're buying it out of the fear of inflation. Well, that's kind of a stupid bet, isn't it? If you think that deflation, so they're buying bonds and they're buying gold. So think about that.
Yeah.
You know, equities are, okay, equities are almost acting like gold because in zero interest rates, you know, and here, let's do the math, okay? Let's everybody think about this. Let's say you had a retirement account of $10 million, right? Just hypothetically speaking. And you're my age, 67 years old, and you go, you know, I don't want all this risk in the stock market, so maybe I'll take a million or two and put it in the stock market with some dividend-paying stocks. And the rest where am I putting it? I'm buying a 10-year treasury? Not on your life, because a 10-year treasury yields 65 basis points, and by the Fed's measure, inflation is 1.3. So every year I'm losing. If everything stayed the same as the service paras, all things stay equal, but of course they don't. I'm a trader, everything's dynamic. But I'm making an investment where I am losing in real terms 65 basis points a year. So after 10 years, I'll have lost in real terms, you know, 8-9% of my money on a compounded basis, maybe a little more. So that's not an investment for me. So I stay short term, but how do I protect the value? So if I have, let's say, $9 million to invest, and let's say I bought a 1-year T-bill for 20 basis points. Do the math. You know how much I'm getting in interest for the year? $18,000 on $9 million. Okay? That's real. That's a real discussion.
Yes.
Who's doing that? So now you've got to go, they force your hand to go search for other things. So now you better put it, so if you're about protecting your wealth, you know, because, you know, you're my age, you're thinking about, well, how am I going to live out my last, you know, God willing, 20, 25 years would be great. And at $18,000 a year, all I'm doing, and my non-U.S. friends laugh because they don't think in these terms, I'm eating into principle. The worst feeling to me is when I'm eating into principle and I'm spending money that that is my savings. You know, I want to leave some to my children, my grandchildren. But if I'm having to live, and not change my life, yes, I could demand. Can I live on $18,000 a year? I'm sorry, I hate to say it, but I can't. I can't. You know, but I've learned, especially during COVID, I'm probably spending 25 cents of every dollar that I was spending. I don't go out to eat. We cook at home. We're not going out to movies. I'm not paying outrageous amounts of money to go to baseball games, golf tournaments, whatever plays. Last year I was going to see Clapton and all kinds of great concerts. I'm not doing that.
Yeah,
I'm not doing that.
It's amazing how much we've learned about ourselves during this time.
Yes. Yeah, I agree with you. But on the other hand, so I can't quite make it on 18,000, but I've learned I can make it on a hell of a lot less if I need to. But I haven't worked, and I'm still working. I'm on with you, and you know that this is a 12 to 14-hour day for me to be able to sit here and talk to you like this and do my trading, do my work, and go to other places and get involved in real conversations and try to promote myself a little bit. So these are real things. So think about that: $9 million in investable funds, $18,000 in earnings. If I buy a 1-year treasury, the safest instrument to park myself. Now you can say, well, why aren't you buying bank stocks? Well, I'm gonna tell you what. Go put up the damn charts of bank stocks. So you're assuming that I'm going to buy them now. All right? I'm 67 years old. I'm not an average dollar. Although I am dollar averaging, I will tell you, in the stock areas that I like, which is I understand that people think there could be deflation, and I'm not a rapid inflationist either. I have to see more. But I'm buying mining stocks and agricultural stocks because they're the most unloved segment of the market. I'm only buying high-quality companies with low debt to equity ratios and have a consistent dividend payout. Even if it's 2.5%, 3%, it's far better than what I can get elsewhere. And I believe the Fed is going to be successful in doing what they want to do, which is create inflation. So if I think that, that's what I'm building my portfolio for. You said, well, why aren't you buying energy? Energy, I just don't know. I'm actually moving into some more green stocks. I mean, I've had one play that has just been great, Ballard Power of late. And, you know, it's one of my green. I have some other ones that I like. So I'm actually moved there, even though they don't meet my criterion. They're ridiculous PE numbers, which I'm not generally prone to, but it's an area that I think has great merit going forward. And I think that the government is going to be spending massive amounts of money on green energy projects. Now it's a matter of finding the best ones. So that's what I'm looking at.
A couple things before I let you go. First is we talked a lot about the dollar today. I'm assuming you're still bearish the dollar, even from back from when we talked about May 26th was that day that we looked at that Tuesday on the chart. What do you see going forward in the dollar? I know that you're not in the business of saying how far low they can go, but just give me an idea of what you think to the downside, and also what would make you not bearish the dollar anymore, whether it's a price or obviously a headline. I'm sure it could do that as well.
Okay. So, you know, currencies are always a relative value, which make it so hard. You know, Alan Greenspan famously said he doesn't understand currencies. He views it as a coin flip. Well, you know, I have a much different view. They're difficult because there are so many variables involved, but that's why I work so hard, because I want to understand what is the variable that comes to the fore that's going to drive the market. You know, most of the time it's interest rate differentials, but that game's shot right now. And so what's the difference between the euro and the dollar when it comes to interest rates? I would say very negligible. In fact, I can synthetically build a euro bond. I can create my own euro bond by buying X amount of Italian, X amount of Spanish, X amount of Greek, X amount, you know, and I can build, and I don't have to buy any German bunds. So I can build a euro bond, which will be certainly competitive with the U.S. 10-year yield, and I'll be in euros. And if I think the euro is going higher, okay, it'll get me into euros, and it won't cost me anything on an interest rate. It's a risky bet, but I don't think the euro is as risky as it was once Schwab made that move. And with what Lagarde wants to do, I think Europe would placate Germany with a stronger euro, by the way. Now, how high can it go? I've discussed the 125 area, and that's really, you know, what is that, an 9% move from here? 8% move? It's not all that great. I've seen currencies. Look at the Brazilian real. You want to see currency moves this year, 60% or so, 70%. So we're not talking about that. Number two, a weaker dollar would fit very well for the world, because this is not a trade issue. This is a finance issue. And because the world is borrowed in dollars, which is why I blogged back in March and April that the Fed needed to do certain things, because they needed to create vast amounts of dollar around the globe to prevent a massive rise in the dollar that some people were talking about, because that would have created the deflationary spiral that they were trying to avoid. So what did they do? They opened up swap lines, which was the right thing to do. They cut interest rates. They did everything they could to weaken the dollar. There was still some shortage of dollars because of the vast amount of global borrowing, 11 to 12 trillion by global corporations outside the U.S. That put a lot of upside pressure on the dollar. Now I talk about those areas, my pivot areas, as I see them right now. Again, technicals are very dynamic, but I look at that 113.30 area in the euro, and let's see exact level in the dollar index for all those who watch the dollar index and trade the dollar index. Give you the same commensurate level because they run very well. Because so much, that's 96.43. We're trading 97.09 right now on the dollar index. So we're close to them, but we've been here, and that's why I think they have credibility. So I'm very patient. Let's see how it evolves. But I am, and it's a relative basis. I think Europe is looking better right now. And then we'll measure the amount of debt. Nobody is carrying more debt than the United States. Yeah, I know Italy does, but I'm talking about as a regional entity. And if I'm talking about a Eurobond and the euro, I'm talking a regional entity. I'm not talking about the single involvement. And if there's going to be any type of fiscal harmonization in Europe, that's bullish. And I think Europe has been underinvested, by the way, and I'm not the only one. You can read BlackRock, Blackstone, KKR, or Apollo. They all have Europe funds that you're trying to put money to work in because they think that European assets are underpriced. So, again, on a relative basis, as they like to throw out, because the stupid media anchors like to have something, the dirtiest shirt in the laundry. It's a relative basis trade. So somebody's up and somebody's down. I think the United States is in a very vulnerable position because of what the Fed has done. And the political situation here is a big negative, and the huge amount of debt that we are taking on, both public and private, is enormous, and it's going to grow because, listen, the Mnuchin's out right as we're talking, talking about a possible another $2 trillion, $2.5 trillion, and that's without a real infrastructure program. So and the municipalities and the state governments, state, regional, municipal governments in the U.S. are going to get whacked from revenue shortfalls. So there's not a whole lot for me to be bullish about in the U.S. I don't care what the stock market is doing, to tell you the truth, outside of the trading vehicle, and that's just the way that I see it. And the Fed is now taking on the role as the Minister of Social Justice by what Powell has talked about with the employment situation. And that was, he said it at the Fed press conference, and then he said it in his testimony last week that the people who lost their jobs, it was through no fault of their own. That phrase, to me, is a dangerous, dangerous phrase for your central bank to make. Because if it's through no fault of their own, does the Fed then stay the course on aggressive monetary stimulus until all those people, blacks, Hispanics, or what in the world they talk about, the people who had just finally, and the Fed really prided themselves on their monetary policies, is creating this, that they were getting a toehold in the best jobs market for minorities in the United States in 40 plus years. So if we wait to get back to there after all of this, the Fed is going to be very, very easy by their own hand. So my barometer becomes this. And it's interesting because Powell came up with the same number. And I blogged about it probably 6-7 weeks ago. So let's say, in order to understand Fed policy, ask yourself this question. It's December. We're after the presidential election. Unemployment in the United States is 9%, and inflation is running 6%. Does the Fed raise interest rates?
I mean, I would say absolutely not. They're not gonna.
Okay, I'm bearish to dollar.
And you don't think they're going to raise interest rates, do you?
No.
No,
he told you.
Yeah.
He told you. They're not going to. I think they would like that, first of all, because let's understand one thing, and for all your listeners, go back and read Rogoff's book, Rogoff and Reinhardt. Not a great fan of Rogoff. He's a very bright guy. I'd much rather read Carmen Reinhardt. There's nothing that cures excessive debt than inflation. The monetary illusion, as Irving Fisher called it. You can get rid of a lot of debt through some years of high inflation and low interest, which is basically very steep nominal yields, negative nominal yields. So if you're at zero interest rates and inflation is 6%, real yields are negative 6%. You want to get to, you don't have to go to negative interest rates. You can get there through inflation. So let's see what evolves. But if you can ask yourself that question, 9% unemployment, which I think is optimistic, by the way, and even Powell felt, that's somewhat optimistic, with 6% inflation. Let's see what the Fed response is. And if you answer it the way you did, why should I be bullish the dollar?
Yeah, I mean, it just comes down to, after everything I'm hearing you talk about today, as bearish as you are the dollar and everything else you talked about, it's hard for me to think that the U.S. equity market's going to stop rallying. I feel like it probably keeps going.
Well, I'll tell you what, if we got a 15-20% sell-off in the dollar, yeah, we'd probably get that real last leg to the equity rally that some people are looking for. The S&P's 3,400, 3,500. So I wouldn't, because then, you're trying to protect, again, is the equity market doing what gold is? I would argue yes, they're both trying to preserve and act as a store of value for your money. Zero interest rates are not so the purpose, the functional utility of currencies is a store of value and a medium of exchange, right? And the dollar certainly serves as a medium of exchange and it rules the world's reserve currency. But is it acting as a store of value?
Yeah. I mean, more I look at it and read into everything, I feel like gold and equities are both looking to, S&P we'll talk about, NASDAQ's already at all-time highs, but it's just one of those things where as a person, it's hard for me to believe that the S&P is going to continue to do it, but as a trader, I look at it and go, why stop here? With everything I'm hearing, everything I see.
Yep. And now you can't even do corporate bonds because the Fed has broken the corporate bond market so bad. How do you value these things? Because as they soak up the more high quality ones, then people are forced to chase the crap.
Yep.
You got to find something.
Exactly.
Right?
That's exactly right. I mean, I look at the bears in the equities and go, what are you hanging your hat on right now? I mean, you just had this, I look back at everything and I go, believe me, as a trader, I like bear markets. They're great trading markets, but yes. I look at what's reality and I go, the bear market is behind us, at least for now.
Yeah. And you got the Fed pumping money and you got the White House who comes and retracts, any kind of negative statement.
Yeah. Exactly.
Right?
I mean, it's like the bad news now is always so short-lived. And there's one thing I've learned in bear markets, right? You need a lot of things to happen to get the move that we saw. An unexpected event. You need to have breakdown of technicals. You need to have continued bearish headlines. We had everything. And then you had extreme negative bearish sentiment on the lows. And then you had the Fed step in and do more than they did in QE1, 2, and 3 in a fraction of the time. And now it's like, is a second wave of COVID going to do anything more than what we're seeing on a day like today? I'm always looking at it as from the trading side. Now I'm looking for the days that are really weak, and I'm probably looking for some swing positions as long as they hold my levels, because unless the news gets really bad, why am I going to get bearish on any sort of break now? I mean, I have to see it proved to me in the charts, but right now I look at everything else that you talked about today, and it's just it's hard to have that story at the short side. Just my 2 cents.
100%. I can't agree with you more. I can't agree with that. And it's hard for me because from the pure fundamentalists, when I operate in that way, it's really hard to find valuations. But as I said, so I'm searching for the unloved sectors that I think will bear a lot of fruit if the Fed is successful by what they want to do. And for the people who tell me, and if you go back and read on the blog, and the conversations on the blog that we go back and forth on with the postings have been just great. And a lot of my readers really took me to task. They were bullish dollars. And I explained, I said, I understand it. I understand the concept of a shortage of a dollar, of funding. But if the dollar rallies, everything the Fed has done is a failure. Because the Fed does that. They won't say it, but everything that I watch them do says they want a lower dollar. So if the dollar is rallying, they have failed. And I still believe that.
And we all know President Trump wants a lower dollar too.
Well, except that he came out, while I'm in the throes of that, he comes out one night and talks about it. Oh, a stronger dollar is great. I go, where does that come from?
I mean, that's, yeah.
I ripped him. I go, wait a minute. Did he read the wrong script? The man 3.5 years has talked about nothing but a lower dollar. Now he comes out when he should be talking about a lower dollar because he couldn't have been more inopportune. Because in the middle of a financial funding crisis, you don't talk the dollar up. Unless, as somebody pointed out on the blog, when I took him to task, well, maybe he wanted to hurt China because, China also doesn't want a stronger because they're borrowing up to shit in dollars too. So they have a lot of dollar funding. Maybe thought he was hurting China. I said, yeah, maybe Navarro was whispered in his ear and said, oh, this could possibly hurt China. Because it was absolutely stupid.
Final thought for today, Ira. And
yep.
It really comes down to what happened to the 10-year. I don't know what else to say to you. It was my favorite product for the last couple of years. I was trading 10-year ultras and 10-year on a regular basis. And obviously, at the beginning of this year, S&P, which was my primary product for many years, became my primary product again. And then, S&P slowed down a little bit. And I said, you know what, let me start peeking my head back into the 10-year. And it really is like a light switch went off. It's unlike anything I've ever remembered in that market. I haven't been super active in it, obviously, nearly as long as I have been in the S&P. But this is just... I don't even know what to say. I just feel like it. Like I said, the light's off.
Yeah, look it, and let's go back to it. I'm looking at it right now. The 10-year note is up 4 ticks, and where the S&P's at? Down 80 handles.
Yeah.
So okay, I guess there's no asset reallocation. That people are moving out of SPOOs and into interest rates. Even the 30-year is only up on 30 handles. 5 is up. I mean, this is no movement, and that's because the Fed. Well, listen, Santelli and I have discussed this for 11 years for sure. That the Fed has broken the signaling mechanism of the bond market now more so than ever, and people who might need to hedge some liabilities out there, they go, why? The Fed, if they do yield curve control, I don't have to hedge. There's no risk to my portfolio. There's no risk to what possibility. The Fed is going to be here. So, but let me ask you, what's the second largest sovereign debt market in the world?
I don't know.
Japan.
Okay.
And the BOJ broke the market so bad there were days. Now think about this. The second largest sovereign debt market in the world, that it wouldn't trade. If you had to make a trade, it was by appointment only. It's not like that. I mean, now it trades up. But it went for a period of time. The bank, you know what? Because why is anybody going to trade it? And you know what? Oh, it was, I'll tell you what, Albert Edwards, was out commenting about it today. I pulled out one of the comments. And he was talking about, be careful as a central bank that you get your wish, because if you're trying to push your currency lower, and he talked about this with the Japanese, you do it by buying bonds. You really want to affect your currency, come in and massively buy bonds. If you buy the market and there's no trade, you're not going to be able to push your currency lower.
I mean, you think if dollar continues to go lower here, like you've talked about, that 10-year maybe starts to get a little more volatile?
Well, you would like it, but the Fed has people off guard right now because they're like me. Again, I have not traded really a curve. I did some Eurodollar curves, very short dating ones, because there was more volatility there. But I have not traded. Now you can go, well, but you know what? I'm symbolic and symptomatic of this market. And if you want a healthy bond market, remember we all celebrate Alexander Hamilton, who ensured that the U.S. would have a healthy treasury market. You be very careful of what you create here.
Yeah.
So, I mean, listen, I don't make the rules. I can only play in the world with the tools that are given. And I have not spent my life fighting central banks, by the way. I will.
That's a tough.
I will
That's
when
a tough
they try
life.
to do something. Well, it's like with the Euro-Swiss peg back in 2015. That one we could fight because you could see that they were losing the battle. 1992, with the Bank of England, I could fight that one because I could see the extremes they were going to support a position that was unsupportable. We are not at that point with the Fed yet.
Yeah. That's why we have to stay tuned.
We will get there.
We will.
We will get there. Because, you know what? Anytime governments try to control markets, it works for a short period of time, but it's kind of like water finding its lowest point.
Ira, what can I say? It's always an honor and a pleasure to speak with you. So much I learned today, and I talk with you all the time, but it's like, once again, just you got my brain working again, and I appreciate you so much, everything you do on the blog. And what can I say? Thank you so much for joining me today. Quickly, give everybody where they could find you on Twitter, and then, of course, mention the blog.
Okay. So Twitter, whoever tweets out my things, I don't, but a lot of people have started doing it, which is good. The blog right now, I'm on a little bit of a hiatus, but this is a good time to go back and review some of them because they're still very relevant. I would go back to February 2020, February 2nd, when we really started getting in and covering COVID-19 in a very meaningful way from a financial perspective. The blog is Notes from Underground. Subscribe, it will come, and then scroll back. WordPress does a really good job. It's archived from day one, which I believe is late November of 2009 or the first week of December 2009. That's how long I've been doing it. And there's probably 2,500 blogs there. So with great comments, worthwhile comments from the readership. You know, I have a very sophisticated readership who really had a lot to it. So I'm very fortunate.
You're the best, Ira. Thank you so much for joining me on Futures Radio Show today.
And no, you do so much great work. You know, people, you know, these are a pleasure in today's world when everything is electronic, because trading is still an information interaction game to do it right. That's all I'm going to tell you. You can make it into a pure number algorithm. Good luck to you.
Thank you for listening to Futures Radio Show. If you enjoyed the show, please leave a review on iTunes. You can listen to all of our episodes on futuresradioshow.com, iTunes, YouTube, Google Podcasts, Spotify, and Stitcher.